to make just a couple of announcements. First of all, we're going to take a break after today's webinar, and we're going to come back on September 8th with Terry Hendershot and his new paper called True Cost of Immediacy. We'll send an email distribution closer to that date, so hopefully we'll see you all there, and hope you have a great end of summer. And also, if you are reviewing for the fall presentations, just a very quick reminder that those reviews are due on August 15. Thank you very much for your help, and hopefully we'll see those reviews soon. Mina is back. So Mina, you're about to take over. Just a very quick reminder for while Mina is speaking, we're going to take questions through the Q&A window, and then Mina is going to pause a couple of times and I'll read the questions to her. Please post your questions there, upvote questions that you find interesting, the usual format. Mina, that's all from me. So thank you so much for coming, and please take it away.
Thank you, Andre, and thank you, everybody. And I'm very happy to present this paper. It's still a relatively new project, and your feedback would be extremely helpful. And in this project, I am studying the effect of passive investing on price efficiency. It is well documented and has attracted a ton of attention that passive investing has been growing spectacularly. And while it may be a good thing for those investors who are participating, there is some concern that such as in uninformed investments, because it allows uninformed investors to participate in the financial market. There is a concern that it will make prices less informative. And given that the information aggregation is an important role of price, this is an important question. Also, there has been a growing literature studying this question based on the RE framework, and this literature has a conclusion that the rise of passive investing or growth of uninformed investment would actually make prices less informative. And this is my question in this paper. How does passive investing affect price efficiency? So in this paper, I studied this question in a theoretical framework. The important ingredient is that investors are going to optimally decide whether to participate in the financial market to begin with. And if they are participating, they can choose whether to invest with informed manager or uninformed manager. And the framework is motivated by Galliano and Pedersen 2018 and 2019. They introduced asset managers in the competitive RE framework of Grossman and Stiglitz, and this framework is very suitable to study this question. And following theirs, I interpret passive investing as optimal strategies of uninformed managers / investors, meaning that I'm taking a normative perspective of a passive investing, that if you are a passive investor, you should do what is optimal for you to do, given that you have no private information. And I will discuss some alternative interpretations in the existing literature and pros and cons. And differently from their framework, I allow informed managers to trade strategically, meaning that they will take into account their price impact a la Kyle 1989. And as I mentioned earlier, I would let investors choose to participate in the financial market. So in the classic framework, investors usually choose to whether to get information or not, but their participation is given exogenously, and it's considered somewhat of a normalization. But especially in this framework, making participation endogenous is actually extremely important. Let me give you a quick preview of results. And really, because informed investors are trading strategically, they respond endogenously to the change in uninformed investment. And increasing the number of uninformed investors actually make the market liquid for informed investors. and this would improve the value of information. Therefore, we would find that decreasing passive fees, which would increase not only uninformed investment, but also uninformed investment, actually make prices more rather than less efficient. And I'll discuss implications for noise trading and efficient markets. And I have some preliminary results on multiple assets with a factor structure that I might mention if we have time. Okay. So here is some of the related literature. And I categorized in terms of the interpretation of passive investing. As I mentioned, Galliano and Pearson view passive investing as optimal uninformed strategy. So this is kind of normative perspective. Another alternative is to view passive investing as exogenously fixed strategies, such as exogenous market portfolio. And among this set, the closer to my paper is the first set of paper that finds equilibrium shares of passive and active investors. And these papers, except for, they also have this endogenous participation. And except for Quorum et al., who have no private information, they are based on this competitive RE framework. And some of other papers, Martin et al.'s paper and Basan Sundaresan, generally they all point to the conclusion that more passive investors or more uninformed investors lower price efficiency. And Basan Sundaresan has a result on cross-sectional, but the result on the equilibrium share is still that the more uninformed investors less price efficiency. So generally, these papers in the literature have a very implication. Another strand of literature is views passive investing as a financial innovation. So more broadly, as an ETF, it relaxes some trading frictions, and some of the new papers that allowing passive investing or allowing ETF help speculation or hedging or incorporating information. Therefore, prices more efficient, but the channel is very different. Okay, so let's go to the model. So the model is very simple Carl-Normer framework with one risky asset and noise trading. And investors have three options. They can save for free. So I interpret this as non-participation or keeping money under the mattress. Or if they participate, can invest with an uninformed manager and pay fee FU. If they invest with an informed manager, they first search for informed manager and pay the fee FI. And there are two sectors of asset managers, uninformed and informed. I interpret uninformed manager sector as passive and informed manager sector as active. And I make an assumption that passive sector is competitive with marginal cost of K, and active sector is strategic, and to really amplify this, I assume that there's only one informed manager. And then I extend to the multiple assets with a that are correlated via structure following Galliano and Pedersen as well. Okay, so this is setting the fourth sub period. At the last sub period, the payoffs are going to be realized. At T equal 3, the uninformed managers trade, they submit optimal demand schedules, as well as noise trading, the SM market clears. At T equal 2, all the investors who anticipate this SM market equilibrium at T equal 3 jointly determine fees of informed and uninformed investors, and at T equals 1, investors will choose to participate and or choose uninformed or informed investors. And two useful notations. I'm going to introduce two useful notations. First is price efficiency. So following Kyle 1918, I'm going to define fee as a fraction of new precision that traders are learning from the price relative to the precision available to the informed manager. And this exactly corresponds to the price efficiency of Grossman and Stiglitz. So as fee goes from 0 to 1, price efficiency in Grossman and Stiglitz also goes to 0 to 1, and in of that maps to Galliano and Pedersen's price inefficiency. I'm going to use these measures interchangeably. The second measure is liquidity. Following Lee and Kyle, I define Chi, measurable liquidity, as basically the inverse of normalized impact. So normally, inverse of price impact is perceived as liquidity. Here, I normalize liquidity with the amount of risk. The idea is that in even the absence of price impact, the amount of risk constrains the amount of trading that risk-averse investors can make. So this kind of captures the trade-off between the price impact and the risk. And using this variable, we can represent the quantity that the informed manager trade as a fraction of that they would trade in a competitive equilibrium. What's convenient is that we can exogenously substitute chi equals 1 the corresponding competitive framework. Should I stop for questions?
Yes, Mina, we have one question from Marios, who is wondering if an information supply channel might also be at work here. Once a stock is included in an ETF, it attracts more analyst attention due to, for example, higher volume, and in turn, this would lead to more informative prices.
I agree that this channel can be present in general. So but I think this is more related to the literature of viewing passive investing or ETF as financial innovation, which makes investors to trade more easily via ETF. But the kind of very different approach here, because investors can trade all the stocks in this model without any friction. So I agree with this, but it is my model doesn't say directly to this channel.
All right, this is the only question we have so far, so we can go back then to the presentation.
Okay, so let's go to the asset market equilibrium. So this is the trading state equilibrium. So first, we can characterize this asset market equilibrium using price efficiency fee. It turns out the equilibrium price efficiency is simply captured this way, where the numerator here is the amount of noise trading. In the denominator, tau represents the precision of the private information of the informed manager, and I is the number of informed investors investing with the informed manager, and chi is the liquidity by the informed manager. Intuitively, price becomes more efficient when the private information becomes more precise. Prices become less efficient when there is a lot of noise. And also intuitively, price is going to be more efficient when there are a lot of informed investors. And what's interesting here is the role of chi. So here we can see that when the market becomes more liquid from the perspective of the informed manager, it would make informed manager to trade more aggressively as if there are more informed investors, and that would make prices more informative. And this channel it really contrasts this model, this framework with competitive framework where chi equals 1. So when chi equals 1, there is no role of uninformed investors on price efficiency. So competitive framework, how many uninformed investors there are is not going to have any effect on price efficiency. This framework, it's going to have effect through the liquidity channel chi. And in equilibrium, liquidity solves this equation, and it captures a very nice intuition. The market is going to be more liquid from the perspective of the informed manager as there are noise trading and as there are more uninformed investors, but as there are but market is going to be less liquid as the information becomes more precise or there are more informed investors. Here, key variable is the amount of uninformed investors. When there are uninformed investors, it's going to make the market more liquid from the perspective of the informed manager. And if we go back here, because through this illiquidity, having more uninformed investors would actually make prices more efficient. Okay, so this is representing the idea in this graph. Again, the key element here, there are two key elements. First is the strategic informed trading. If there was no strategic informed trading, price efficiency is going to be completely independent on the amount of uninformed investment. Second is endogenous participation. So here, it's a partial equilibrium. We haven't really solved the participation yet, but in the classic framework, the number of people have to choose either informed or uninformed, then that really mechanically connects the amount of informed investment with the amount of uninformed investment. And so if you have this kind of mechanical relationship, you would have exactly the opposite result. The price is going to be less efficient when there are more uninformed investors. And I think this captures the kind of conventional intuition that people have. But this conventional intuition is coming from first with exogenous participation and second the competitive trading. And next is on the general equilibrium. So anticipating this asset market equilibrium, investors and managers are going to choose the fee. In this simple framework, we find the fee relative to the certainty equivalent that informed and uninformed investors are getting. And I'm going to focus on interior equilibrium, where investors are indifferent among all three options of non-participation and uninformed investments and informed investments. Then we can find that general equilibrium amount of uninformed and informed investments are going to be determined so that value of information, or UI minus UU, which is the certainty equivalent differential between informed and uninformed investment, is going to be exactly 2 times the cost. And the certainty equivalent of uninformed investment, meaning the value of just participating in the financial market, is going exactly the same as the exogenous marginal trading cost that uninformed managers pay per investors. So the key really that if you will remember just the one equation from this paper is this equation, the value of information. So because informed managers are trading strategically, when they think about the value of information, it depends on the liquidity. So when you think about it, when you have information, it's not just about how good the information is, but also about how much you can trade upon it. So if market is very liquid with chi equals 1, you basically get this part 1 plus tau over 1 plus p tau, which corresponds to the value of information in the competitive framework. But market is not perfectly liquid. You have this opportunity cost, this 1 minus chi over 2 e to the 2 gamma chi part, and this part corresponds to the opportunity cost due to imperfect liquidity. Because market is not fully liquid, you cannot trade as much as you would like to, and relative to uninformed investment, you are losing that part, and this is a really key aspect. And you can also think of this value of information as the performance difference between active and passive investment. And the next is the value of participation, and value of participation is going to generally decrease in price efficiency. So if prices are gonna reflect all the information, there's no real benefit of trading. And also value of participation decreases in the amount of uninformed investors. Together, we can characterize equilibrium price efficiency with this one equation. And there are two key implications from here. First, in general equilibrium, how efficient the price is has nothing to do with the amount of noise trading there is. Both informed and uninformed investors are responding to the amount of noise trading. It's not going to ultimately affect the efficiency in general equilibrium, and this is related to the idea of Stambaug's paper, because they view the increase in delegated investment as decrease in noise trading, and they interpret this decrease in noise trading would lead to more efficient prices. In this model, that channel does not work. Another implication is the comparative statics with respect to the trading cost of K. So to remind you, K is this marginal trading cost that uninformed manager pay for investors. So this is ultimately just the technology cost that we can think of as passive fee. And C is the search cost, and here we can interpret this as the spread between active and passive management. So I'm going to show you some pictures to give you an idea that why price becomes more efficient as this cost decrease. So first, so this is generic. Everything happens at the same time, but I can kind of look at each channel one by one. So as the cost of trading cost decreases, it makes the passive investment cheaper. As passive investment becomes cheaper, there are more uninformed investors, or more investors entering the financial market and choosing uninformed investment. But this increase uninformed investment, as I said earlier, would actually make market more liquid for uninformed manager. And this more liquid market would make information more valuable. So for even given information, you can trade more and get more value out of it, and it would actually make more investors also choose the informed manager. So although and both uninformed and informed investors are growing, but uninformed investors are growing faster, so the share of uninformed investors will be growing as passive fee goes down. But then, and also, but the effect of the equilibrium liquidity is somewhat ambiguous, because the uninformed investors tend to increase liquidity, but this increased liquidity make informed investment more attractive, and informed investors also increase, and the effect on overall liquidity is going to be ambiguous, but what's clear is the effect on price efficiency. And price efficiency, so unlike a partial equilibrium case, in general equilibrium, this increase in price efficiency not comes directly from the effect on the liquidity, but from the effect on the value of information. So more uninformed investors make informed investors investment more attractive, and that's why the prices become more efficient. And again, we can compare this with a competitive framework where informed managers do not trade a strategy and then they do not respond to the fee for passive investment. The next is effect of declining search cost, or the declining the spread between active and passive investments. And intuitively, this is going to make prices more efficient because information is cheaper. But this increase is much, much smaller than you get from a competitive benchmark. So this is a competitive benchmark where decreasing search cost all the way to zero would make prices fully efficient. And this is also related to the efficient market limit result of Galliano and Pedersen. They argue that search cost goes to zero, price is going to be fully efficient. But this is going to be, this is not going to happen in strategic framework, because as information becomes cheaper, more investors choose informed investment. It will actually make market less liquid. This lower liquidity will make information less valuable. So the resulting effect on the price efficiency is more muted. Do I have any questions?
Yes, Mina, there are three questions. The first one is from PK Jain, who is asking about capital constraints. In particular, he says, if more investment capital moves to passive instead of active funds, then informed investors may be unable to exploit all available opportunities fully because of capital constraints.
Yeah, so here, so I think you're thinking about the kind of moving from uninformed to uninformed. Yes, that can happen, but here what happens in this model is that both informed and uninformed investments are growing. I also think that this is what happens in what we also observe, although the passive have been growing, active investment, it has been also growing as well relative to non-participation or the direct investment. Here, my interpretation of direct investment is more of like noise trading. So instead of just direct investment or non-participating, more are investing in both informed and informed. And that's kind of the is that works in my model is that, so we see that investors are moving from passive to active.
All right. And then the next question comes from Jaideep Oberoi, who is asking for clarification. He says, once an investor pays cost C, can they identify the informed manager for sure? One of the issues that leads to attractiveness of ETFs is that it is difficult to identify the informed managers even after paying a cost. My understanding is ex post performance studies point to this problem.
This is a very good point. I'm aware of this problem here. I assume that you can identify whether the manager is informed or uninformed, and we don't. This model doesn't address this question fully. I agree.
Okay, and then the last question is from Tukan Tuzun, who is asking, how do the investors who have information about macroeconomic fundamentals fit in this framework? Can these investors strategically trade in and out of the passive funds?
Um, that's a good question. I don't have my model doesn't have a really answer to this. I think so my model doesn't have investors choosing different types of information, but I think I have preliminary research on multiple assets that may be related to what Tukan might be thinking about. So maybe I will that up briefly.
All right. Then that's it for questions, Mina, and we can go back to the presentation.
Okay. So just to clarify, so this is a kind of preliminary research. Let me discuss this quickly. So I introduced multiple assets using a factor structure following Pedersen. So that means both all the fundamental, meaning the payoff of the asset, and the error in the signals about the private signals about the fundamental and the supply shock have this factor structure where beta represents the on this factor. And what's nice about this factor structure is that you can have these orthogonal eigenvectors span the whole SS space. So basically you can interpret the SS space as a space of these orthogonal portfolios. And portfolio that is proportional to the factor loading beta, it will be called a factor portfolio. And portfolios that are orthogonal to this factor portfolio is going to be idiosyncratic portfolio. Then we can extend this concept of liquidity, price efficiency, and the value of participation to a portfolio. So the liquidity of a portfolio is going to be similarly defined as the trade-off between the price impact on the portfolio and the risk of the portfolio. And the price efficiency of portfolio is also going to, inefficiency is going to be defined similarly to the conditional variance given the prices relative to the conditional variance given the signal. And the value of participation will be also defined similarly. Nice about this is that you can actually find rotations of these any portfolio so that you can actually rank the liquidity, efficiency, and value of participation according to their any given portfolio's loading on the portfolio. And I can provide conditions under which the factor portfolio, which we can think of it as a systematic or some representation of market portfolio, is the most liquid and the least efficient and the most valuable for both uninformed and informed investors. Unfortunately, this condition is kind of complicated because the liquidity is determined as a solution to the function. But under a fairly generous setting, I find that the factor portfolio is the least efficient and the most valuable for uninformed investors. And this means that if uninformed investors were to choose just the one portfolio ex ante, it would be factor portfolio, and that is related to the implication of the kind of more positive aspect of passive investment. Okay, so let me conclude and maybe answer. I think I went a little fast, but the key conclusion of this paper is that the growth of passive investing actually can improve rather than harm price efficiency. Thinking about strategic informed trading and endogenous participation is very important for this question.
Thank you very much, Mina. The discussant for today's paper is Gideon Saar. Gideon, please take over the slides and go ahead.
I would need to share my screen, so Mina needs to stop sharing her screen. Excellent. Well, thank you, Andre, for inviting me to discuss this paper. I really enjoyed reading Mina's paper. Mina's paper builds on two recent papers by Nikolai and Lassie that basically introduced the notion of a search for asset managers, investors search for asset managers within the context of a Grossman-Stiglitz asset market framework. And so the new things that Mina adds to this framework are two things. First of all, the informed manager incurs price impact on trades, right? So now he needs to trade strategically. And second, turn off the AC here, that investors choose whether and how much they want to invest with both the uninformed and informed managers. So it's not just exogenously uninformed versus informed. Now we've got the option of not participating in the asset market, uninformed and informed. And the main implication of the model, the way I see it, is that as the cost of the uninformed investors, which Mina called passive investing, declines, of course, more uninformed investors participate in the financial markets and price efficiency increases. And the interpretation here is that, we've seen over the past decade is the cost of investing via index funds and ETFs have gone down. There's been an explosive growth in utilization of index funds and ETFs. And this could, according to the model, have made markets more informationally efficient, which is kind of the surprising result. So why do we get this result? So here, Mina went very nicely in her presentation over the step, right? First of all, when the cost of uninformed investing goes down, the number of uninformed investors goes up. That's very intuitive. More uninformed investors make the market more liquid. That's also very intuitive. And the informed managers trade more aggressively when the market is more liquid. And also in the general equilibrium, there are also more informed investors. And therefore, prices become more informationally efficient. And to me, the logic seems intuitive, seems very reasonable, maybe because I come from the market microstructure perspective, not asset pricing or delegated portfolio management. And a good portion of that logic has always been there, at least for the past 3.5 decades. If you just simply take HILE 85, you increase uninformed trading, liquidity improves, and the informed investor trades more aggressively on her information. So in the HILE framework, the informational efficiency prices doesn't change, right? The amount of informed investor trades more and the uninformed kind of cancel each other. But of course, models can be tweaked. And here, what I like what Mina does is she shows very clearly how her assumptions bring the different result. That it's not just enough to have the, we've got the strategic trading of the informed investors and the endogenous participation of the uninformed investors and how the combination of that generates this result. And, I think this is a very nice result. Mina took an existing framework. She asked new questions, right? She was kind of looking at the robustness of the assumptions about competitive informed trading, exogenous participation of investors, and generated a very interesting result. So I'm going to make two comments, and my comments are not going to be about the internal validity of the model, which I think is fine. My comments are going to be a little bit more of how the model relates to what we see out there, right? What the model is supposed to represent. And the first issue is that Mina associates uninformed investors with index funds and ETF investors. Right? Passive investing, and because, and the reason people are writing about it is because there's a lot of interest in index funds and ETFs. Some people are worried about the fact that so much investment goes through those channels. Now, Bill Sharp, the guy who received the Nobel Prize for the CAPM, back in '91 wrote a very amusing editorial called The Arithmetic of Active Management. And in this rather controversial editorial, he basically said that outperformance of active management simply goes counter to basic arithmetic. And his logic is as follows. Let's say that the listeners of our Microstructure Exchange seminars are all the investors in the S&P 500. Let's say half of them, can be any portion, let's say half of them are boring index fund investors like me, and half of them are exciting active managers like Andre. Okay? And in aggregate, we hold the entire S&P 500. So if the S&P 500 did 10% last year, of course, the index fund investor like me, we did 10% because we simply replicate value-weighted the index. And the question is, how much did Andre make? Well, I don't know how much Andre made, but the active investor industry in aggregate, right? That becomes a one linear equation in one unknown, and the answer is 10%, right? It could be that Andre, could be, Andre is phenomenal. He's an active manager, did phenomenal return. But if that's the case, right? Remember, the index funds are simply holding the value-weighted portfolio, which means the aggregate of the active industry also hold the same thing. And so if Andre phenomenally outperformed the index, it has to mean that somebody else, some active manager, underperformed the index very badly, right? Because let's say Andre wanted to take a bet on Apple. So Andre will overweight Apple. He needs to buy Apple shares from somebody. I'm not going to sell it to him, right? Because I'm holding value-weighted portfolio. I'm not trading. My prices go up, down. I'm a value-weighted portfolio. I'm an index fund. So some other active manager will have to sell share in Apple to Andre and overweight and underweight Apple. Okay, so that's the arithmetic of active management. So how is that relates to Mina's model? A key to the result that the cost of uninformed trading goes down, informational efficiency increases, is that uninformed demand or trading offsets demand by the informed investors, right? This is kind of the way it's written in the model. As there are more uninformed investors, aggregate demand schedule from uninformed investors becomes steeper. This in turn implies that the residual supply schedule of the informed investors becomes flatter, which means lower price impact and higher liquidity. Okay? And so this is key, right? If we want informed investors to trade more aggressively, that needs to happen. That's how informational efficiency improves. Which means that the counterparty to the informed manager in the model are the uninformed investors. If the informed managers choose to overweight an asset, the uninformed investors must underweight. And this doesn't sound like the arithmetic of active management of Bill Sharp. It sounds as if the uninformed investors in the models don't behave like passive index funds, right? Rather than holding the value add, they simply accommodate the trading needs of the informed investors. Now, in her conclusion, Mina talks about the fact that uninformed investors supply liquidity to the informed investors. And I completely buy that. In fact, I think I wrote at least one empirical paper where I show that individuals, most of them will be uninformed, supply liquidity to institutions. So I completely buy that notion. The difficulty comes when you start thinking about these uninformed investors as index funds, right? Why would they change it? They're holding value-weighted. Why would they change their portfolio to accommodate whatever the informed traders try to do? And this could be also an issue with Nikolai and Lars's framework, but I think that here it becomes even more acute because Mina assumes endogenous participation of the uninformed investors, so it's kind of more striking. And I think that much more thinking and much more discussion in the paper needs to be about this issue. Okay, so that's the first issue I wanted to comment about. The second issue is that general equilibrium result, right, as the cost of investing with the informed manager goes down, informational efficiency increases is because, right, the number of uninformed investors increases, which makes trading on information more valuable and attracts more informed investors, right? And Mina explained it nicely. Now, here's a figure I took from Morningstar, and it shows the net flows into US equity fund. And for the past 5 years, you can see net inflows into passive managed, that's the kind of a bluish, grayish, greenish thing, and net outflows from actively managed. So at least when you look at this universe of actively managed, it's not as if informed investors went up. They actually went down. And the question is, if they do not go up, if they go down, whether we can replicate in the model that informational efficiency improves. And so this is a little bit of a different set of statistics than what Mina mentioned when she responded to one of the questions. So why does the number of informed investors go up in the model? It has to do, in my mind, kind of a big thing, has to do with the way fees and access to managers is structured, right? So Mina assumes that all investors have access to all managers. So the only equilibrium that she considers is the one in which all investors make the same, irrespective of the investment venue. And therefore, in the general equilibrium, the fee that the informed investors pay is a linear function, and we saw that earlier in the notes, of the cost of the uninformed investors. So as the cost of the uninformed investors go down, it means that the fees that the informed investors go down, which no doubt attracts informed investing. So what can be done in the model about it? And here, so the picture I showed you had to do with US equity funds, active and passive. And perhaps Mina, when she said, but more money comes, she says, well, there's a larger universe out there. Maybe hedge funds are not in the picture, maybe. And so maybe hedge funds are part of this, informed active management, which can be. And I don't know of any, comprehensive set of numbers. But when you think about the hedge fund, let me take Seth Klarman, for example. I would love to invest with Seth Klarman. I don't think Seth Klarman will take my money. Hopefully invest Cornell endowment's money. He loves Cornell. He donates lots of money to Cornell, and we love him for that. But I don't have access to him, right? So perhaps one of the ways to resolve this is to introduce segmentation in the access of investors to managers. Not all investors can access all managers. And hopefully if you introduce such a segmentation, you can introduce it, and that segmentation definitely exists in reality. In fact, it's highly likely that most of those that have access to passive investing, don't have access to some of the informed investing. And perhaps when you introduce that segmentation in access, you could decouple kind of the fee of the informed investors from the cost of uninformed investing. And I think it will be worthwhile to demonstrate in the model that the result, that increase in informational efficiency as the cost of uninvestors go down, can be decoupled from the increase in informed investor. Maybe it doesn't require any increase. Maybe you can do it with a decrease. We know in the partial equilibrium, right, when the number of uninformed investors goes up, the number of informed doesn't change, right? But informational efficiency improves because the informed investors trade more aggressively. And so we just need to show something like that in the general equilibrium as well. So to summarize, I think it's a nice model. I think that the main result that Mina gets is both interesting and intuitive. And in particularly, I like the way Mina explains and shows in the model how the different results generate the outcome. I think this is what you would want to see in every theoretical model because it produces a lot of transparency. I think more needs to be done with respect to the connection of the model with passive versus active debate in asset management and matching maybe some of the stylized facts. So that's me. Thank you.
Thank you very much, Gideon. We have enabled the raised hand function for you guys to raise your hands and ask your questions live if you have any. Andreas reminded me last time that we do the NBR style, which means that Mina cannot respond to Gideon directly. But maybe after everybody's questions have run out, Mina, you'll have a chance. So our first question is from Leon Young. And Leon, please unmute yourself whenever you're ready.
Thank you, Andrew. Can you hear me now?
Yes.
Great. So this is a great paper, very interesting results. So I have a follow-up question on Gideon's first comment. I think that's a very intriguing comment. But to me, in the baseline model, Mina's baseline model, that's only one asset. So she can interpret that one asset as the equity market. So that concern might not be really a concern, I think. So it's more like still the uninformed traders hold the market. There's no component, just the quantity, either more or less. I just want to know whether my interpretation makes sense. So it's more like the multi-asset setting. Gideon's comment applies more relevant for the one asset setting. Maybe it's kind of less a concern.
Actually, if I don't mind me jumping, because I wanted to say that, but here's the thing. What Lian described is what people call tactical asset allocation, right? There's a difference between strategic, tactical, and security selection. So basically, we basically trade the market. I'm underweighting the market, overweighting the market, except this is perhaps 0.1% of the active management industry. Practically 99.9% of active management industry is security selection. And most of the kind of puzzles are about security selection, not about tactical asset allocation. So if it's about tactical asset allocation, then the model will need to be phrased very differently, because the truth is that many people do tactical by, in fact, buying and selling passive funds, which are the index funds, as Lian said.
Yes, maybe the interpretation is different. It might be about the timing as opposed to selection. Skill is about the timing, inform the traders. Yeah, that's all. That's all my question. Yes, thanks.
Thank you. This is a great question. I was also thinking about this. So there is this kind of cross-sectional aspect and time series aspect that Lian pointed out. This kind of what uninformed investors are doing in terms of adjusting their portfolio is more like time series rather than cross-sectional. And here I'm interpreting this cross-sectional, the timing strategy without any private information as a kind of passive investment relative to kind of timing based on the private information as active investment. And my understanding is that there has been growth in this kind of timing strategy in the Gallian and Pedersen talk about how the kind of active sector actually has moved toward more time. There's more a profit to be made in this timing rather than relative value portfolios. But that's something that I can think about. But this very important point, because I don't think we really know quite well how to interpret passive investing in this kind of RAE framework, because on the other, a lot of literature actually has this kind of market portfolio, but we know in this Cara normal framework, the kind of mean supply changing the number of shares available for each asset has no effect whatsoever on price efficiency or liquidity on this kind of interesting variable. So you can fix this kind of sort of market portfolio, but it does not really capture what we have in this CAPM work. The way I think about sort of like the direction that I'm taking this paper with multiple assets is more sort of like single asset, single index model rather than the CAPM model. But I completely agree that thinking in towards like a kind of CAPM or this kind of more traditional asset pricing framework, integrating those framework with the REE better and thinking better is an important issue, and I appreciate. And responding to Gideon, the comment that I appreciate your comments as well.
All right. We don't have any more raised hands at the moment. Mina, would you like to address Gideon's comments? Not respond to them, because that's against Andreas's wishes, but address them.
Yeah. So thank you. These are very great discussion. I will have to think about them, all of them, more carefully. One thing that I just want to re-emphasize in case I didn't really emphasize enough for the audience is that one of the important things that that is not in the existing literature but is here is the channel on the value of information. And so, you know, uninformed investors make the market more liquid for informed investors, and that make the trade more aggressively, and that's kind of happens in partial equilibrium. And we, you know, as a market microstructure crowd, that is very familiar. I want to take one more step that that it actually makes the information more valuable, because this kind of a value of information, the kind of information acquisition literature is more on the competitive framework. They don't really incorporate this liquidity perspective. So exactly because I can trade more aggressively, a given information becomes more valuable, even though the precision is the same, the price informativeness may be the same, but still it's actually more informative because I can trade more freely. And that is also related to another question of whether I'm making informed investing mechanically cheaper. And that does not happen, because what's important for investor's decision is not the total fee for not the total for the informed, but the important aspect is the spread, which is the value of information that I'm capturing. But the key channel is not mechanical, but the channel, really the fundamental channel that strategic investors understand that more liquid market makes their information just extra valuable, that more people want to become informed. And that's what happens in the, so that's at least the channel that's happening in the market. But then you had another question of whether it is realistic, and the statistics that you show that the fund there has been outflow in the active, that is a little different from the that I saw, but I certainly take a look at. And your idea about adding segmentation is great. I think it can make the model richer. Another point, another kind of element of the model that I haven't explored and I have been meaning to is kind of corner equilibrium, because initially, so I think, you know, in 1970s, 80s, there has been steady growth in participation in the financial market. I think in the early days, both active and passive grew, but maybe there is a limit at some point that, you know, maybe everybody who was gonna participate in the financial market already participated. Then after that, you have kind of corner equilibrium where investors are no longer indifferent between not participating and informed investment. So that kind of corner equilibrium can also capture some of the idea of this. I think there was another question about this flow from uninformed to informed or informed to uninformed. Those aspects can be captured in corner equilibrium, but I would think about your idea as well. I think that would make the results more richer. I appreciate that. Yeah, I think that's basically my response. I think every comment that you had was extremely useful. Thank you very much.
Thank you very much, Mina and Gideon. We are coming up to the top of the hour, so it's time for me to officially end this webinar by thanking all of you for coming, and Mina and Gideon for taking the time to share their ideas with us. Just a quick reminder, we are going on break until September 8th, when we come back with Terry Hendershot and the paper titled True Cost of Immediacy. So look for an email from us in the first week of September. I do not see any more raised hands. Let's just give folks a second. Still none. So I think this means that we are done, and hopefully everyone has a great rest of their summer.
Thank you so much. Take care.
Thank you.
Bye-bye.